Why is the Fed going to keep slamming the door on stocks? It all has to do with inflation, the massive stock market rally we've had, especially in the mega caps, and their fear that inflation will get out of control, even though there's signs that it's coming under control. There's things that look entirely too bullish for the Fed to stomach. Uh, the earnings coming out on major companies, in a way, is inflationary. Meta came out with wonderful earnings. They beat on both revenue and earnings. Their revenue increased 11% to 32 billion. Their earnings came in at $2.98 when $2.92 was expected. Even minor increases like that is a big deal to Wall Street. More than 3 billion people use some Meta product daily. This includes Facebook, Instagram, WhatsApp, and Oculus. They're expanding their services in many ways. They're developing a thing called Threads, which is, I think, going to be exactly like what Twitter was. And they're taking advantage of Twitter being in turmoil. Elon Musk has rebranded Twitter as X. X marks the spot. He wants to make it a more inclusive app that does financial dealings. It's going to be kind of a fintech app and a social media messaging app at the same time. And he was involved with PayPal before, so he's well experienced with all of this. And I think Meta feels like they've got to expand and they've got to compete with all these other social messaging platforms. And so they're doing Threads to compete with Twitter, which is now becoming X. And they're also going to do Reels, Reels, which is short videos. It's basically competition. I think it's going to be exactly like TikTok, only it's going to run on Facebook and their other services. Reels, Threads had an advantage and got 100 million users right out of the gate, simply because if you were on Instagram, you could get on Threads pretty easily. Reels, it attracted more advertisers. The problem with Threads is that the people from Instagram have gone on it, but they haven't returned to it. So there's this like flash of 100 million people, but they're not really returning to the Threads. I think it's because it's really not offering anything new or different so far. Reels is attracting advertisers, and that was the main push with it. They wanted to attract advertisers to Facebook and to Instagram, and Reels has been drawing in more advertisers, so that part's been successful. Meta is still spending 88 to 91 billion on their virtual reality metaverse project. So that's still taking a lot of expense, taking a lot of money away from Meta. And it's so impressive that they can spend that amount of money in 2023 and still be massively profitable. Their price to earnings is still only 27, which is really good for a mega cap. So it's definitely a buy. It looks like they're starting a lot of projects that they should know how to do, and they should know how to parlay it into greater profits. And their third quarter estimate of revenue is higher than what analysts have predicted. So it looks like a bright future for them. They are creating trouble for Twitter, which is now being rebranded as X. Uh, X is going to offer advertisers a 50% discounting on advertising to compete more, because advertisers have been turned off. Some of them by Elon Musk himself and some of his political stuff. He's been saying has not been going over big with the Tesla crowd. Even though people love their Tesla cars, they're not exactly thrilled with the things that he does with Twitter, which is now becoming X. So Thursday morning, the stock market was jacked. Okay, we got wonderful earnings from Meta, good earnings from Microsoft, great earnings from Google, and we were all set to take off. And then the gross domestic product blew past all expectations. It came in at 2.4%. Only 1.8% was expected. There's not going to be any recession anytime soon from the appearances of the GDP. And on top of that, we got core personal consumption expenditures. That's the PCE, which the Fed loves to follow. The PCE came in lower than expected. It was expected to come in at 4%, and it came in at 3.8%. It hasn't been below 4% for a year, I believe. So this was very good news, and the market immediately shot up like it was going to the moon. The Nasdaq went up to over 200 points. Okay, and so we thought things were great. Okay, but the rally is so sensitive to any negative news now. It came out that in Japan, their central bank, Powell raised our interest rate 1/4 point. Lagarde in Europe raised their interest rate 1/4 point. And Japan just hinted that they might raise their interest rate above 0.5% eventually. Now that's eventually. And so that was seen as hawkish. Imagine that you say it could go be above 0.5%, that's somehow how hawkish. But I guess the yen, the Japanese currency, is somehow very important in currency exchange and currency dealings. And so I guess it's a big deal, because the currency traders have always relied on the yen having super low interest rates. And right now it's a negative 0.1%. So, wow, if they go over 0.5%, that's like massive in their minds. It just shows you how your reality can be so contorted by what you've been taught to perceive. So that was, the stock market was flying high until that came through, and that's kind of a black swan out of nowhere event. And the market went from being up over 200 points, that's the NASDAQ I'm talking about, because that's the main stock market I trade. It was up over 200 points, and by the end of the day, it was down over 70 points. So any hint that, it should have been bullish in a way, because if they're going to be more hawkish and raise their interest rate, that should lower the US dollar in comparison. And I'm a little bit confused, but I think it has to do with its importance with currency exchange, which I don't totally understand, but I guess they rely on that a lot, and it affects things in a major way. And Japan is the third largest economy in the world, so it's a big deal when they do things. But it just shows how uncertain ground we're in. And there's no recession imminent. And I think the number on the PCE was good. The core inflation came down a little bit, and that's what they've been trying to do for so long. So the stock market should do well, but I think we have a factor going on here that's going to keep it from really booming. I think it's going to muddle along and maybe go up a little bit, but I don't have big expectations anymore, just because I can see how devoted the Fed is to crushing the stock market. And they're going to do it by offloading their balance sheet. They already raised the interest rate a quarter of a point. And I don't think he wants to raise the interest rate that much more unless he has to. But he can also raise the interest rates by selling off their balance sheet. On their balance sheet, they have like 8.6 trillion of assets, and they've been selling those off. They were selling them off, but then the banks got in trouble, and so they added 300 or 400 billion to it. But now they've been selling it off for the last month or so, and it's down about another 400 billion. And I think by what I hear him saying, I think his intention is to keep offloading that balance sheet in case he has to do quantitative easing in the future. He will be able to do it more easily if he gets rid of a lot of the assets that are on there now. But anytime they sell off their balance sheet, that raises interest rates in the bond market. And that's another factor on Thursday that tanked the stock market, in addition to what was happening with Japan. The interest rate on the 10-year bond went up 13 basis points to 4%. And that's the first time it's hit 4% in a long time. And this affects mortgage rates and all consumer-like things like that. And they are worried about inflation. They know the July number is going to be skewed towards being worse simply because of the base rate effects. Last July, there supposedly was zero inflation for that 1 month. And so that makes this July's number, which comes out on August 10th, it's going to make it look much worse than it really is. So you got all these factors that are affecting the psyche, I want to say, of the Fed, and they're going to keep socking it to us. They're going to do it mainly, I think, by offloading that balance sheet, which raises interest rates, which makes things less affordable. And they are still worried about inflation because we have these hot parts of the economy. The durable goods order for this month came in at 4.7%, almost 5%. Durable goods orders increased by almost 5%, 4.7% to be exact. And it was expected that they would only increase 1%. So I think the Fed is seeing numbers like that. And I don't think they'd like to see all the wage increases that are occurring. And many are predicting that we're going to have a crash of some kind eventually if the wage increases get out of control and we get into a price wage spiral, which would be awful, and which the Fed, they will both offload their balance sheet and raise the interest rates. And I think there's only a certain amount the Fed's going to allow the stock market to go up. And so we have all these factors entering in, and none of them are particularly pleasant or good. So right now, my forecast is that I think Jerome Powell wants the stock market to just sort of muddle along and maybe go up a little bit, but not much more than that, because it could create inflation. And he really doesn't care if the stock market doesn't go anywhere. In fact, if it would go down 5 to 10%, he would probably be relieved. So thanks for listening and watching. Be sure to hit the like button and subscribe if you haven't already done that. I'll keep trying to keep you updated on this changing market, which is so sensitive now to any negative news. Thank you.